You're now listening to episode 25 of the Real Estate CPA podcast.
Your source for all things real estate, accounting, and tax. Here we reveal our secrets that can save you thousands in taxes, streamline your accounting process, and help grow your business. Stay tuned to hear insightful interviews with industry experts, successful real estate investors, and current clients on what strategies they use to grow their business and how they steer clear of Uncle Sam.
Hi, everyone. Thanks for tuning in. Brandon Hall and Thomas Castelli here with seasoned real estate investor Matt Faircloth to discuss the state of the real estate market, investor relations, raising capital, and much more. Since 2004, Matt and his wife Liz have gained vast experience in bringing both residential and commercial properties to their highest and best use. This includes repositioning single-family homes, multifamily, apartment buildings, mixed-use retail, and office space. Before we jump right into today's episode, we want to remind you about our virtual workshops. They are not a webinar, but rather our virtual workshops are a highly interactive experience that puts you in a room with our tax strategists as well as fellow real estate investors. We will discuss a topic for the first 15 to 20 minutes and then open the room up for questions. This is the perfect opportunity to get answers to those real estate tax and accounting questions that you've been dying to ask, while at the same time discovering what other real estate investors are asking. You could sign up for our virtual workshops by visiting therealestatecpa.com/virtual-workshop or by following the link in the show notes below. And without further ado, let's get right into the show. Matt, pleasure to have you on today. Would you mind giving us a little bit of background around your story and how you got started in real estate?
Sure. Thank you, Thomas. Thank you, Brandon, for having me here. So my backstory is that I graduated from Virginia Tech with a degree in engineering, but realized very quickly I didn't want to be an engineer. I didn't want to do what an engineer did. So I got a job in sales, did that for a while, and then got into real estate in 2005, which was a great time to get into real estate. Quit my day job, got married, quit my day job, and started investing full time. And I survived the uptick and then survived the downturn, in 2009, 10, 11 in there, and have built a business of real estate ownership, real estate management, since 2005. And have gotten into all kinds of cool stuff, such as, we've done apartment building deals, we've done single family home deals. We've done a lot of fix and flips. We own an office complex. We're into a lot of interesting stuff, and we continue to expand. We do a lot of it, through raising money from investors and raising passive investors that want to get involved in what we do without doing the day-to-day stuff that it takes to own real estate. So that's me and my company in a nutshell.
As you know, one thing I just noticed you said there was you survived the uptick and the downtick, the recent recession. And some of our clients, some of the people in the industry at this point think we may be close to the top of the market.
Mm-hmm.
And we are. What's your opinion on that? And what did you attribute to surviving the last downturn?
Oh, well, okay. First of all, I don't know. And I think that there's a lot of opinions out there on what the market's going to do. I can tell you, being someone who went through the downturn, that there's a lot of theories out there that we're due for the downturn because it hasn't happened for a while, or because, that's like sitting at the roulette wheel and betting on a double zero because it's due, because it hasn't hit in a while on the roulette wheel. And so then not a good excuse. The economists that are way smarter than me have looked at our current economy, and they do not feel that or the ones that I've talked to anyway, have told me that they don't think it's overheated. The economic indicators show that we're going to keep going, and that companies still have good ratios to price to earnings, and there's still good indicators that the economy is going to stay going. As a real estate guy, what I see happening is interest rates going up. And we're buying an apartment complex right now and being quoted at like 5.25, where the apartment complex we bought 2 years ago, we got a rate at 3.375 was our interest rate. And so now I'm a full 2 points above where the market was for money. And so I think that will start to affect larger real estate. And I think it's going to crash. The people that are talking about a crash, forget it. It's not. I just don't see it. I just don't. I do think that things are going to slow down. And aside from like a third party thing, World War or something bad happening, so some catastrophic events or something like that, that could throw us all through a tailspin. But I don't predict a real estate crash. There's a lot of people I see that are just sitting on their money waiting for the market to crash so they can get in. I don't think that's a good reason to do that, but I do think things are going to slow down, which would probably be good for us if they just pulled back a little bit and maybe got a little less aggressive. So that's what I think. And it'll be nothing like what we saw in 2008, 2009, which was complete like standstill, bottom fell out. It was bad. I mean, it's not something that anyone should wish should happen again. The people that are wishing for it to happen again don't own any real estate. You know? Right.
But they might after after such a crash.
They know, but they don't have the balls to go out and pick it up themselves. They don't. Pardon my French. They don't have the courage to go out and get it. They don't realize that when that happened, you could not get a loan. You could not get equity. You could not get anything. The reason that it stopped was because the flow of finance stopped as well. That's why the bottom fell out. And also because of overinflated mortgages and subprime garbage and stuff like that. Because of all that, that's another reason. But you couldn't go and just buy any piece of real estate you wanted to for super cheap price. You couldn't get a loan. They didn't see the other side of that. I did.
Yeah. Good. Great thoughts. Excellent thoughts.
Yeah.
Let's assume that a crash doesn't happen, but let's assume that there's a downturn or a pullback.
Yeah.
Moderate, not crash level, not run for the hills level.
A slowdown. Right.
A slowdown. What do you do as a real estate investor? What do you do to protect yourself during something like that?
Well, I'm locking rates for as long as I can right now. When we do refinance or because again, rates are going to go up. And so I'm trying to lock interest rates for 10 years for most of my purchases or refinances of property or whatever. That's what I'm that's the biggest thing I can do. I'm also I try and buy in areas that are somewhat recession resistant. You can say people say recession proof. Well, you can't be recession proof. You can be recession resistant though. I don't do luxury real estate at all because I think that if we do have a slowdown or a topple, if there is a bubble, it's in luxury real estate. If you look at the price of schwanky, nice real estate in nice A+ areas, that's really what's run up big. Like, prices of properties in San Francisco and lower Manhattan and whatever. So I don't do stuff in luxury A+ markets. I do workforce housing, for folks that are just the bread and butter of the economy, earning their income right around the median. That's the kind of real estate that I do to hedge my bets against the slowdown.
That's exactly the way I look at it too. Workforce housing, being C-class assets. I always look at it as during a recession, those assets are going to be the ones that are going to be protected. The higher end stuff, people can always leave because they don't need it, but you need somewhere to live. So why not? I look at that being C-class space as that perfect in between.
Mm-hmm. Yeah. And not D-class assets, not A-class assets, maybe like a C+ somewhere in there. That's what we go after.
So, with all these different assets you have, how do you end up handling your accounting and bookkeeping side of the business? Do you handle it yourself or you outsource that?
We're in the middle of a transition right now. It's funny you bring that up because I was actually at a conference, if I can plug you, Brandon, that you got into you've like planted all kinds of little seeds in my head, man, when we were waiting out in front of that restaurant at the Mid-Atlantic Summit last year. He's like, well, have you tried Bill.com? I'm like, have you tried this? Have you done that? I'm like, no. And so since that conversation, you spurred a lot of inspiration in us as a company to, get with the program and start and do more online accounting and look at right before that, we had a full-time office manager that ran a lot of our financials and ran a lot of our bills coming in and out. She was working 40 hours a week. We're now transitioning out of that position and looking to do a lot of our work through just third-party bookkeeping, through eChecks, ACH, third-party services to run our books and to keep our financials, QuickBooks Online, which we've been able to do because we used to manage the real estate directly. If you do that, if any of your listeners are doing that, they need a third party. I think they need a third-party service like Rent Manager, Appfolio, Buildium. What's the other one? I might have missed one. Oh, Yardi. One of those four to do their company financials. You can get QuickBooks to do it, but as I understand, you guys could probably debate me on this. It'd be a good conversation. I understand you have to trick QuickBooks into running real estate directly, meaning like tenants paying rent into the system and everything like that. Is that true?
Yeah, we don't recommend QuickBooks for property management. QuickBooks would be the software where you consolidate the financial reports, like going out to your investors or just your own financial reports. But you would definitely need something like an Appfolio or Buildium that it's actually managing the properties, paying the
Yep.
bills, collecting the rents, all
We
that.
used to. Appfolio's like, Craigslist merged with merged with QuickBooks, but it understands how to work with tenants as well. Yeah, we love Appfolio and Rent Manager too, and they're all great. But our property manager uses that, and they send us a wire for our proceeds at the end of the month, and then they send us a P&L and an owner statement, right? Then we take that and we reconcile that in QuickBooks to say, and then we collapse a lot of the sub accounts. Like they'll send me, I don't know, maybe 30 sub accounts for maintenance, and I collapse them all into maintenance,
Yep.
like it'll be, plumbing and electrical and plumbing labor, materials, and so it just all breaks down, which is good to understand it. But then when I'm sending a consolidated financial to my investors, they kind of sort of don't care what we paid in electrical versus plumbing versus this versus that. As the asset manager, I need to see that. But then we collapse it all into maybe 7 or 8 line items. And then our investors get a consolidated P&L.
How often do you send out these consolidated financial reports to your investors?
For bigger properties, again, this is what we're going to be doing. Again, this is with Appfolio. Yeah, Appfolio doesn't let you. I mean, you can collapse some of it, but it's fairly robust and it can be a little more complicated. But moving forward, I'd like to be sending out stuff once a quarter to investors.
Yeah.
Right now, for one of our bigger assets, we send out a statement once a quarter, and we're just sending them the statement we get from Yardi through our property man. This is for a 198 unit complex we have in North Carolina. We send them monthly summaries, like bullet points. Here's how we did, and then quarterly we'll send them a financial statement. Investors have a lot of trust for their asset manager. It's really, I view it to be on us to do deep dive into the numbers for them, and then send them a brief. Here's what vacancy was, this is what rent collection were, this is what this looked like, and most importantly, this is what you're going to make. So we send a deep dive quarterly financial, and then monthly quickie updates.
So you're taking the property management reports and you're sending those to investors, and your plan is to move to like a QuickBooks Online and consolidate that into more professional financial reports. Is that what I'm hearing?
Yeah, well, yes and no. I mean, the PMs send us really detailed reports, but I want to collapse it to where I think investors want to see, this is how much rent we made, this is the bills that we paid, this is how much is left. And it doesn't need to be a six-page financial report. I should be the one reading that.
Right.
They should be the one reading the half a page financial report.
Yeah, because we've had similar experiences with our clients that are running syndications. They sometimes, before they come to us, they're running everything out of Appfolio, Ability, Yardi, or one of the other ones, and they're trying to do all their financial reporting there too. And we've experienced the same thing where, hey, these systems are amazing for property management. They're not that great for reporting to investors. They're great for you to look at. They're not that great for reporting to investors for a number of different reasons. One of them that you cited, which is I just want to collapse the data and not show the investors a ton of stuff because it's just going to overwhelm them. They want to see it anyway.
Or, I mean, it'll cause your investor to focus on something that doesn't matter, because they may look at that and be like, hey, wait a minute, your landscaping's gone up, 10% in the last 3 months. And they're like, well, that's because it's summer. Okay. That's what happens, but I know that, right? But they don't. And then I don't want to give them more data than just, not that they need, but just then it's necessary for them to get into an analysis mode on. But actually what we're looking to do is to make the P&L that we send match to the categories that are shown in the offering memorandum. So I can say, this is what we said we're going to do, right? This is what we are doing. So you can look to see you can have an offering memorandum for a syndication shows, year one, you should show year 1, year 2, year 3, this is what we're going to do. And those reports, those projections are not 3 pages long. It's normally 1 page, a half a page, whatever. So what we want to do is to mate it to what we sent in the offering memorandum to say, budget versus actual for each year. So investors, we can hold ourselves accountable that way. That's really what they want to see, I think.
100% agree with what you just said. Investors don't really care about the nitty gritty details. They just want to see the high level overview. And if you can show them, hey, look, this is what we said we were going to do, and this is what we actually did, that not only builds trust with your investors, but they better understand what they're investing in and, what they can expect from you in the future. And the more clear you can make that for them, I think the better it is for both parties.
Yeah.
When it comes to your tax situations, like do your investors ask you about how this will affect them tax wise, and how do you go about answering that?
Yeah, no, they that's a big question, and I mean, we get a lot of people that come into our projects that's one of their biggest questions is like, how's this going to affect my tax? Then they'll have a self-directed IRA, so we'll talk about unrealized business income tax UBIT. I was going to just say UBIT, but I didn't want to just sling an acronym out there without So we'll talk about UBIT. We'll talk about the passive loss that they get through owning the real estate in their own name if they have it, or in an LLC if it's not through a retirement account. And so I make sure they understand the benefits of the tax benefits of owning real estate. Some of them have never gotten a K1, so they don't know what that is. I have to explain that to them and explain to them, okay, listen, the K1 is going to say one number for what you have for your carry through income, and then you're going to get a check for something different. And so let's discuss that. So I make sure that we go there. A lot of times for apartment building ownership specifically, taxes are one of the biggest benefits that they get in being involved in real estate.
And I know you might have mentioned before that you were contemplating doing a cost seg study on one of the properties you owned.
Yep.
Where are you currently at with that study in the evaluation phase?
Sure. Well, we own I'd mentioned it before, a 198 unit building in North Carolina. We're buying a 166 unit complex in Lexington, Kentucky. And so on the new one, we may put it into the offering memorandum. But on the one in North Carolina, we did not put it out there in the offering memorandum that we were going to be doing a cost seg study. I think that you need to make investors aware that you're going to do these kinds of things because it creates not so much a taxable event, but it creates a conversation. It creates a thing, this perhaps major deduction on their K1 because of the cost segregation study that you're going to do. That they should be aware of it. But I also view, and I don't know if we should back up and get into what a cost seg is, but I view them as a double-edged sword. That it's not. There's some investors that they just love them and they do them on every deal that they do. I see both sides of how it's a positive, but there's also negative. I see negative sides to it. You guys can talk, we can debate that, but I see the negative side of it, which is pretty much what happens when you sell.
Yeah, just to recap for everybody, a cost segregation study is when an engineering team or an accounting team will go into your property and break down the building's components into different class lives. And usually anywhere from 25 to 30% of your building's value can be classified as 5, 7, and 15-year property, which is depreciated at accelerated rates. And with the new 2018 tax law, you actually depreciate the entire value of the 5, 7, and 15-year property in the first year. And that usually creates significant passive losses.
Mm-hmm.
And the benefit of that is you get increased cash flow in the beginning years. The downside to that is there's depreciation recapture tax, which is taxed up to 25% on the back end once you sell the property. And I think that's what you were talking about, Matt. The downside, the dark side of it.
Yeah. Well, there's investors out there that let's say I owned an apartment building in my own name, or not my own name, or just I own myself. I didn't syndicate it. Then I want to hold it for as long as I want to hold it. And then I want to sell. I can then sell it and then do a 1031 exchange where I can do I can defer the income tax, defer the depreciation payback, defer all that stuff and roll it into the next asset and then do a cost seg study there and then start the carousel all over again, right? And if you are a sole owner, then you hold it for, hold it for as long as you can, keep doing tax deferred exchanges, and then, at some point die and pass it along to your kids or your heirs. And a lot of the tax stuff gets wiped, right? That's the way, that's layman's explanation of this, not a CPA's explanation. But because we're syndicating and because we're bringing in large pools of investors to be a part of these deals, we can't, not that we can't, but it's difficult to do tax deferred exchanges and to get out to like herd the cats and to get all the investors to agree to we're all going to stick around for another 5 years and trade into the next deal. Probably is not going to happen for larger stuff. We've done 1031s on smaller collections of investors, but for the one in North Carolina, we have 35 investors, so the chances of them all agreeing to roll into the next one, it's probably slim. One of those 35 is going to say no. And more likely half of them will, so that's the double-edged sword. But talk to me, why is that not or is that a concern or is that not a concern, or is there a way around it? Take me to school.
Well, I would say that if you're going to be doing large syndications and you get a lot of accredited investors in there, chances are they're going to be taxed at 35, 37% tax bracket, right?
Sure.
So they're getting to defer that income because you're doing the cost seg and you're getting those depreciations and you're essentially getting a loss. They're not paying the income they could potentially be paying at a 35 or 37% tax rate. Whereas when it's recaptured, it's only recaptured at a maximum of 25%. So
Hmm.
if you think about if you didn't do the cost seg and then you did have income, say you did show a positive income, they're paying it at 35, 37% on that income, whereas they're only recapturing at 25%. So there's a 12% spread there.
Mhm.
So that would be, on a syndication, assuming most of them are accredited investors, I think that's where it makes sense. But, to your point, I also agree that if you're going to try to do the 1031 route, it is very difficult to do on a syndication.
Yeah.
There's a couple other factors there too. Like can your investors even take the passive losses if they're generated? Um, unless they are, unless they or a spouse is a real estate professional, or they have passive income to offset the passive losses that you're generating, they might not even be able to take the passive losses, just depending on their personal situation. And they might instead just become suspended and carry forward. But like you said, we have clients that will not engage in cost seg studies because they don't want to have the shock and awe at some later point when they have massive gains that their investors are going to report as a result of taking the cost seg study in an earlier year.
Yeah. Yeah. I think that you're pushing a lot of things forward that if you do sell, you got to pay the piper, man. I mean, you don't get the money for free. Thomas, I really liked what you said about that 12%. That's a real valid thing worth talking about. But, Brandon, what you said is interesting too, because some investors, some passive investors they actually they can't take advantage of it like I can, because I can build up a huge pool of passive losses. I believe, not to like get controversial, but that's how Donald Trump didn't pay taxes for like 10 years, right? Because he had so much passive losses built up that he was able to burn it off over that time. You guys know better than I do, but isn't that what happened?
Partially. He also utilized a loophole in the tax code that was subsequently closed after he utilized it. So yes and no. But
Boy.
yeah,
Yeah.
yeah. But yeah, I mean that's a good point because I mean I can see it. Like there's syndicators that look at it and say, oh wow, cost seg is definitely something that I need to do for myself.
Yeah.
But what about your investors? Where do they stand? And our syndicators that do use cost seg successfully will generally have something in the operating agreement that the investor is signing, or they will be talking to investors about this and making sure that
Yeah.
they can use it. So they kind of like understand their investor situation from a tax perspective before they pull the trigger, which is really interesting because now we're not just real estate investing, we're actually trying to maximize our investor returns.
So this is an interesting conversation, and I didn't even know we were going to go here on your podcast, but I just thought I got two, super smart tax guys in front of me here. And I think it'd be good for your audience for a cool conversation. We own an office building, and I've got a solar guy that's banging on my door to put solar on the roof of this building I'm sitting in right now. And the way that he's been talking about doing it is saying, like, okay, you take a high net worth individual. That high net worth individual becomes a partner with you, and they front the money. The solar system has a 30% dollar for dollar tax credit, meaning every nickel that he puts up for that system, 30% of that gets a direct credit on his income tax, not a tax deduction. He gets a tax forgiveness for every dollar, for 30% of that cost of the solar system. On top of that, we get to depreciate 100%. 100% of the depreciation cost could kick in 2018. If we do it in 2019, is 50%. Still a nice benefit, right?
Mm-hmm.
There are some LLC shell games you have to play to pass all of those benefits over to the investor, to where me as the owner of the building, really what I want is I want cheap electricity. I want electricity from off the grid, from the solar system. I happen to be in New Jersey. New Jersey has these things called SREC, standing for SREC, I think Solar Renewable Energy Credits. And you get a credit from the Board of Public Utilities each month for the amount of KWs that you generate. I'm totally butchering this thing, but you're shaking your head, Brandon. You know what I'm talking about. So different states have different things, but the Board of Public Utilities pays you for however many KWs you generate in that month. You get like a credit, and it's a commodity. It goes up and goes down. So what are your thoughts on the tax benefits of solar that I totally summarized right there. There's way more to it, but that's what a solar guy is pitching me right now.
Yeah. So I am not an expert on solar nor the solar credits. It gets really complicated really fast because you do have the state and local credits that also need to be factored in addition to the federal credits. Now, what I believe how it works on the federal level is when you put any type of solar on a property that is generating passive income, the credits will only offset the tax associated with that passive income. So in order for anybody to take the credit, the property needs to produce positive net income after depreciation. And then the credit will be taken against the tax that is spinning off from that positive income, if that makes sense.
It doesn't pass through. Like, so if you're an LLC, you can't pass that
through. But I could not go and put, and this is just my understanding, I could be totally wrong. But from what I believe that I understand is I could not go and put solar panels on my rental property and take a 30% credit on my personal tax returns for the cost of the solar panels. What I could do is that credit sits there, and any year that my rental property produces net positive rental income, it then produces tax associated with that net positive rental income, which I can then offset with the credit that's sitting there.
Well, what you could do is you could sell the rental property within a couple of years, because I do understand that there is a sunset clause on those tax credits. I think it's 5 years that you got to use them. And so, as you know, rental property, unless you've got a screaming hot deal, rental property, because of depreciation and because of everything else, not it's like solar depreciation, just the property itself, they don't make a whole lot of money on paper after you've taken a lot of the deductions that are associated with them. You make your most of your taxable money comes in after you sell them. They make cash flow, or they should, and they're supposed to. But on a tax perspective, they actually don't make a ton in that. So what if you were to put solar on a rental property and then sell that rental property, and that would create a taxable event, but you would be forgiven that tax, I would think, because again, these are three guys. We don't know. We're not like solar experts or whatnot, but it's an interesting conversation. And I think that it's one of those things that more real estate guys should be looking into, because hey, it's a good thing to do. You're kind of freeing the planet of all this carbon that we're pumping into the air. And also there's some benefits out there for it, which I think are not as broadcast as they could be around it. So I thought I'd be curious to at least bring up the conversation for interest,
Yeah. I believe that it works in the way that you just described. So if you liquidate the property, you have capital gain. You can use the credits to offset that. The problem with that is capital gain is taxed at a maximum 23.8%. So I'm using credits to offset something that's, I guess dollar for dollar, it wouldn't really matter at the end of the day. So yeah, we'll just call it viable. And then we'll just say it's depending on your facts and circumstances and the location that you live in. Please contact your provider to learn more.
Yeah. I again, I think it's one of those things that is interesting, and one more tax thing to bring up, those SRECs are not taxable. Like when you get those renewable energy credits from the local board in New Jersey anyway, from the Board of Public Utilities in New Jersey anyway, the SRECs are not taxable income, which is pretty cool.
The one thing about the tax credits for the energy, for the solar, is there's a bunch of clients who did ask me about that like a few months ago, and I did a whole entire like research report for them on exactly how it would work. I just don't recall off the top of my head. So if you're out there and you want to know about it, feel free to ask your tax advisor. Feel free to ask us, and we'll get you an answer. Right now, we just can't give you a definitive answer.
This just goes to show that there are, and again, let's like all the way back, right? There are so many great tax benefits that I'm preaching to the choir, but so many great tax benefits that you can check out in real estate, and that's cost segregation analysis, solar, just the simple concept of depreciation and how it benefits a passive investor, possibly, and how it benefits us benefits me as the operator or the general partner. I mean, we sold an apartment building one time, like a big apartment building that we were the sole owners of, and we got to keep every dime because we had so many carry forward losses. As real estate professionals, we got to keep all the money from selling this apartment complex tax-free. It was phenomenal. It was a really, really great shot in the arm for our company. And so I just think that real estate is such a great vehicle for tax creativity, for tax benefits.
Yeah, there's a person in one of my mastermind groups that makes a living off of getting her clients to invest in Georgia film credits. Now, I have no idea what those are or how they work, but it sounded cool when she was talking about them.
Yeah.
You are right. There's tons of different tax things that you can do, and a lot that, man, even us, like we like to be creative. We bill ourselves out as creative real estate CPAs. We try to figure out
Yeah.
cool things that we can do to help lower your taxable income. And then I hear about Georgia film credits, and I'm like, man, we're just
Yeah.
surface over here.
There's another thing called conservation easements. Have you heard
Yes.
about those?
Oh yeah. Yeah.
Yes.
Yeah, a buddy of mine just talked to me about it, and I'm like, "Holy wow, man, that sounds insane." Tell you, and so he explained it to me, and not something that again I get enough write offs that I don't need to look into that. But this, buddy of mine's a dentist that makes gargantuan. There's a lot of money in pulling out teeth, uh, and so he makes a lot of money, running dental operation, and so he was looking for creative ways to reduce his tax burden, and he found these conservation easements, and I mean,
Yeah.
it's like just really interesting what's out there,
We have a show coming out, I believe, in a couple of weeks after releasing this show on conservation easements. So we've got a guy that does this, and we are going to be interviewing him. So
That's
stay
awesome.
tuned and check us out here in a couple of weeks if you want to learn
I will be
more about
listening to that show just out of curiosity more than anything, because it just sounds like a really, really creative way to reduce tax burden. So
it. Yeah, it's phenomenal. So Matt, you wrote a book called Raising Private Capital not too long ago. What are your top 3 tips for raising private capital that you wouldn't mind sharing with our audience?
sure. So this is there are a lot of tax conversations, because there's conversations as a I think that I'll do tip number one, that the book talks about deal providers, cash providers. So a deal provider is somebody who goes out and finds a apartment building deal, goes out and finds a fix and flip, goes out and finds the opportunity. There is the cash provider, somebody who is going to invest passively without taking the day-to-day operations on in the deal. They're the person that puts in money. The deal provider puts in time. Okay. You marry those two together and you have a real estate private equity relationship, right? I think the first tip that's in the book quite a bit is the deal provider needs to be sure that they understand the tax implications of things that are available for the cash provider. Understand the cash provider's goals. Are they investing in an IRA through an IRA? When are they going to retire? Are they a high income earner that they would benefit from tax write-offs and tax deductions? So be able to speak intelligently. It takes for having a really good CPA in your corner, but as a deal provider, be able to speak intelligently about how what you're offering a cash provider is going to help or even hurt them from a tax perspective. I've had people that wanted to invest in equity in fix and flips with cash out of their own pocket. And I said, you don't want to do that, because you're going to end up having to pay, the government a big chunk of what you make in on the equity side of these fix and flips. That's a capital gains event, and you have to pay capital gains tax. So being able to explain that to them is number one. Number two is real simple. Everybody knows people with money. We've raised millions of dollars in equity and in loans for real estate transactions. We've done 35 million in transactions involving some kind of private money, either loan or equity. And the bottom line is that I'm not a member of a country club. I didn't go to an Ivy League school. I'm not just, bred all around money and that's how I did it. These are just, I was able to build it up originally through my own personal network and then slowly took it out from there. And so I submitted that anyone reading that book, if they look at it the right way, they know there is money in their network that they can tap into themselves. And the book gives them the tools on how to look for it, where to find it, how to close it, how to bring it into your business. And the third thing that the book talks about is cautionary tales, personal stuff that's happened to me where we've had bad things happen in the real estate business involving private money, and how to avoid those things. And also just how to unwind a private money arrangement, because people don't talk enough. People talk about finding deals, finding the money, but that's half the conversation. Then making it operate and run properly, and then unwinding it is the other side of the conversation. So those are the three quickie tips that are in the book, among many, many other things.
And if if you don't mind me asking, how do you end up, like, what CRM do you recommend, a CRM software for somebody to use to manage all of their contacts for their investor
I
relationships?
do. We looked at Salesforce. We looked at some of the other ones, some of the big ones that are out there. Pipedrive is another one. But we ended up going with Podio, which is pretty much like a super open template, open form type of thing. I mean, it's like WordPress, where if you know how to use it, you can program it to do whatever you want. And so we use Podio for our investor database. What I like about it is Podio talks to, we use a newsletter, like an eBlast newsletter, MailChimp. When Podio talks to MailChimp, it talks to Google Forms. When people want to invest with us, they fill out a Google form that populates Podio, and then they automatically go into our newsletter database and stuff. And when I'm talking to a new investor or an existing investor, I can just pull up Podio and type in my conversation I'm having with them, so I can just keep the database updated. So there's a bunch of database softwares out there, but I think Podio is one of the ones that works for us because of how versatile and flexible it is.
Yeah, we used to use Podio pretty extensively until we actually switched to a more stringent project management platform. We still use Podio for our CRM, but Podio was extremely flexible, and it helped us scale the way that we have. We've been able to modify it however needed. The flexibility eventually led to issues with project management. So we actually ended up needing something that was not flexible so that we could manage our projects better. But yeah, love Podio, love the integrations. Very cool to hear that you're using it too. Mm-hmm. What would you say your strongest marketing platform is? How do you best connect with these folks to let them know that you exist?
Well, okay, I have a YouTube channel, youtube.com/DeRosa Group, DEROSA Group. And that's my YouTube channel is something I've been shooting YouTube videos for probably 4 years, 5 years, something like that. Brandon, you and I might have done a YouTube video together. If I haven't, we should. And that, but we do probably 2 to 3, sometimes 4 videos a week on our YouTube channel, and we just pump out just good, wholesome content, real knowledge, not too self-promotional aside from talking about deals that we're actually doing, and just real education about real estate. And that's been far and away a great way to get our name out there, to raise our hand in the air, to say, hey, we're folks that know what we're talking about, and you should hear more about what we're doing. And that's drawn people that want to learn from us, and also people that want to invest with us.
Awesome. So if you had to give one last tip to our audience on, whatever you think would help them in their investment careers, what would that be?
Have goals and don't give up. So it sounds like a Anthony Robbins kind of thing, but it's not. It's just you've got to set really good goals that are focused, and then don't change your mind off of, don't lose focus on those goals, and then don't let a bad day or a bad week or a bad month pull you off of that. Because I attribute a lot of my success to just staying focused on my goals and staying focused on what I want to see for my business, for myself. Even if speed bumps tend to pull me off.
100% agree with that. Can't be a shiny object chaser, and you got to be very disciplined on what you're chasing, what you're going to get. So, Matt, I would thank you so much for coming on the show today. We definitely appreciate you having you on. What's the best way for our listeners to contact you?
So they can just go to my website, derosagroup.com. They can check out my book, Raising Private Capital, on that website. They can buy a copy of it. They can hear more about it. Just go to derosagroup.com. They can hear more about investing or just learn from us, whatever it is. Just more about us as a company. It's all right up there on our website.
Awesome. Well, thanks again for coming on the show, and we will let you know when it's out.
Sure. Great. Thanks. Thank you so much for having me here with you guys. Look forward to talking to you guys again soon.
Thanks, Matt. Have a good one. Thanks for listening to today's show. If you enjoyed the show, please find us on iTunes and leave us a review. You can also email us at contact@therealestatecpa.com with any feedback or topic suggestions. We are always taking on new clients, and with the new tax laws in play, you really don't want to navigate this alone. Let us help you save money on taxes and with your accounting and CFO needs. To become a client, navigate to our client page at therealestatecpa.com and fill out a web form with as much detail about your situation as possible. Thanks so much for listening. Have a great rest of your week.